Hi everyone, Bill Lethman here for MoneyEvolution.com. In today's video, I'm going to be answering the question, what happens to my Social Security benefits if I retire early? So this is a very common question, very popular here with our existing clients and also with questions that we have coming in from our blog and our YouTube channel. And so what I'm talking about here isn't necessarily what happens to my Social Security benefits if I retire prior to my full retirement age. That's a different video that refers to how your Social Security benefits will be reduced. What I'm talking about here is what happens if you decide to retire early. So recently I went online and I downloaded my own Social Security statement here, and it's got some details there, of course, about how much my estimated benefit will be at my full retirement age and how much that benefit would be if I retired at age 62 and age 70. And if you haven't already downloaded your Social Security statement, I highly encourage you to do that. It's very easy. In fact, I had done this a while back, set up an account. I think it only took a matter of a few minutes, and then yesterday I went online to get it and I forgot my password. I actually forgot my username too, so I had to go back in and do all that, and even that only took me about 5 minutes to kind of get reconnected with Social Security. But they have this line here that's very important on the statement here, and it says that this estimate is going to be based on you continuing to earn X number of dollars from now until that time when the benefit is estimated for, age 67 or age 62. So what happens if you want to retire at 55 and you've got 12 years maybe where you're not going to be making any income at all? What happens to your Social Security benefit? So that's what I'm going to try to get into here in today's video. I've really kind of boiled this down, I think, to make it relatively easy here, and I'm actually very excited about that because the Social Security Administration, they've got their worksheets and things, and it can be a little bit more complicated. All right, so let's talk about how Social Security actually calculates your benefits, and I'm going to spend a little bit of time on this. So one of the worksheets here that you might want to download. In fact, we'll put a link here in the description below this video so you can go ahead and download that. But it's a Social Security form. It's called Your Retirement Benefit, How It's Figured, and it goes through kind of a step-by-step. Kind of looks like an IRS tax table is kind of the way it's laid out there, or tax instructions, I should say. And basically they have this whole gridded worksheet here, and I actually kind of started filling some of that out myself for my own benefit here. But basically you're going to look at your year-by-year actual earnings, and again, your actual earnings as it pertains to Social Security benefits. So those are usually capped in every year, so there's a maximum amount that of your earnings that Social Security will tax. And then there's also an index factor. So the intention of that is to try to take some of those older income years and kind of make them more relevant to today's dollars. So for example, and I've got my note card here with a bunch of numbers, in 1984, the maximum Social Security taxable wage base was $37,800, and if you hit that upper limit, you would multiply that by an inflation factor of 3.12, which would make that equivalent in today's dollars, according to Social Security, of $117,936. So one of the popular misconceptions, I think, is that people are saying, well, obviously I'm making a lot more money today than I was making back in 1984, 1985, and how does that impact it? Well, they do make some pretty nice adjustments so that even if you made some fairly decent money back at those ages, it's going to kind of round that up to what would be more likely today's dollars and everything. And what Social Security is going to do is they're going to use your 35 best years of work history. Okay, and that doesn't necessarily have to be 35 consecutive years. It could have been, if you're an NFL player and you made a whole bunch of money for the first 10 years and then you haven't made very much, they're going to look at whichever 35 years have your highest earnings, okay? And then they're going to basically add all of that up, and they're going to do it again on an inflation adjusted using that index factor there, and then you're going to come up with a big number, all that income year by year added up, and then they're going to divide that by 420, which is the number of months in 35 years, and that number is going to be what they call your AIME, which stands for Average Indexed Monthly Earnings, and then that's going to be what they're going to use to calculate your Social Security benefits. And you can imagine filling out that table is going to take a lot of time. Now they do have some tools, and we'll try to put some links down below to that as well, where you can actually use some calculators to have some of that work done for you. But there's still a lot that goes into that, and you're still going to have a lot of time spent on putting those calculations together. All right, so let's start diving in a little bit deeper into some of these numbers, okay? So using our example here, we're going to once again assume that your age 67 or your full retirement age benefit is going to be $3,069 a month. And we know that that is going to be based off of a formula that the Social Security Administration uses that's going to be based off of that AIME number, the average index monthly earnings over your entire 35-year work history. And we know that also includes those years that are in the future, because again, it's going to assume that you're going to continue making that same level of income from now until whenever that date is, full retirement age or age 67 or whatever it is. So what we want to do is maybe we want to come back and see what is that lifetime earnings that Social Security is using to calculate this number, and what is the average index monthly earnings without necessarily having to go through and fill out this entire spreadsheet. And so we can do that by kind of working some of the math backwards here. And the way we do that is we're going to look into how Social Security actually calculates that number. And so we know, according to this page here, your retirement benefit, how it's figured, this report here from Social Security, that the first $926 of your AIME is going to get multiplied by 0.9%. Okay, so we know that we have at least that much money, $926 per month, times 0.9 equals $833. So what that's telling us is that $833 of that $3,069 benefit is going to come from just $926 of that AIME. Then we know that step two of this is that Social Security says that the amount between $926 and $5,583 is going to get multiplied by 0.32. So the difference between those two numbers is going to be 4,657 times 0.32 is 1,490. Okay, so the next chunk of that $3,069 is going to come from $4,657 of that AIME number. So if we add those two numbers together, that's going to come up with 2323. Okay, so that still doesn't make up that entire amount. So the last step of this is that Social Security says that any amount of your AIME that's over 5,583 is going to then get multiplied by 0.15, and then that's going to be the final component of that $3,069. So we can kind of work that number backwards. Okay, so we know that so far we've used up 5,583. Okay, so we know so far that we've used $5,583 of our average index monthly earnings, and we've also accounted for $2,323 of that $3,069 estimated benefit. So now what we're going to do is we're going to take $3,069 and we're going to subtract that 2323, and this is where we're going to start doing a little bit of the math backwards. That's going to be $746 is the difference between that $3,069 and what we've already accounted for, okay? And now we know the final component of this calculation here by Social Security is going to be to multiply any amount that's over 5,583 by 0.15. So we're going to kind of do the reverse of that. We're going to divide 746 divided by 0.15, and what that's going to equal then is 4,973. Okay, and what we're going to end up with now is the average index monthly earnings, again, without having to fill out this whole long spreadsheet and everything. So we're going to add that to 5,583, and that's going to bring our grand total. I actually grab my calculator because I didn't do that number. 5,583 plus 4,973, 10,556. Okay, so now that we have the average index monthly earnings that Social Security is using to calculate our benefit, now we can take this a step further, and we can now make some assumptions and say, well, what if we didn't make those earnings for a number of years? So remember, according to that Social Security statement, in this example that we're using here, Social Security is counting on you to continue making $127,200. Okay, so we're going to use an example here and say, what if you retired 5 years early and you basically had a bunch of zeros in there instead of having the $127,500? So the way we're going to do this is we're going to take that AIME number, the 10,556, and the first thing we're going to do is we're going to convert that, or we're going to change that into the lifetime total earnings that are indexed that Social Security is using. And we're going to just multiply that by 420, which is the number of months in 35 years, and it's going to be a really big number here, 4,433,520. Okay, so we know that this $3,069 is based off of that total lifetime indexed earnings of 4,433,000. Okay, so now we can say, okay, well, what happens if we don't work for 5 years? So 127,200 times 5 is 636,000. And we're going to subtract that. I should have wrote it over here, 636,000. And we're going to subtract that from the 4,433,000. So now 3,797,520. Okay, and then again, now we got to convert it back into our average index monthly earnings. So we're going to divide that by 420, and that is now 9,041. Okay, so over here, you could see that chopping off those 5 years really didn't make that much of a difference on that average index monthly earnings. Okay, but let's see what the impact is on the Social Security benefit. Okay, so now we're going to run through that same example, and we know that 23, or actually $5,583 of that 9,041 are going to account for our $2,323, and we can just kind of work the math backwards there and subtract that 5,583 from that number, and that's 3,458. We're going to multiply that, try to figure out where to stand here. Multiply that by 0.15 is $518. So when we add 518 over here, in fact, I'll just do it here, 2323 plus 518 brings that to 2841. Okay, so hopefully that made sense. So basically we took our reduced lifetime earnings for Social Security, we divided it by 420 to get our new monthly amount. We subtracted 5,583 because we know we have at least that much of income, and that accounts for $2,323. We had $3,458 that was over that 5,583 number. We know that gets multiplied according to Social Security by 0.15, so that's going to give us an additional 518 in addition to that 2323. So our new total is 2841 compared to the old number of 3,069. So that's a difference of $227 per month. So I hope that makes sense. Okay, that's a little bit easier way to do it, in my opinion, than going through this whole worksheet here. In fact, I've seen some other videos online where they got spreadsheets going and Excel, and they're running through all these numbers and everything, 30, 40-minute videos and everything. And this is a kind of a quick and easy way that you can calculate that. Now, in our example, I tried to simplify it a little bit, so hopefully you got a pretty good understanding of this in the fact that we just said, okay, what if you just chopped off $127,000 for 5 years? But in reality, if you do go through this worksheet here and you're going to kind of maybe circle those 35 best years, and it might be that you've had a long enough work history where, some of those years, even in your 20s. I was talking to a client the other day, and he was talking about, when he first got out of college, he made $28,000 a year back in, I think, like 1985. Well, that pushed him up. That year accounted for, about $115,000 of adjusted income. So really, by kind of chopping off a couple of these years at the end, for this individual situation, really didn't make that much of a difference here. So, we're kind of using an example here where, if you only have 30 years of actual work history and you've got 5 years that are zeros. So you can see that probably wouldn't really have that big of an impact. And I know that's one of the concerns a lot of people have is, well, this thing is based off of this assumption that I'm going to continue making this big salary here for, the next 5 years or 10 years or however long. But in reality, again, it's not going to really have as much of an impact as you might think. So, with that, I hope this has been helpful. I hope you got a pretty good understanding of how this works, a little bit of a deep dive into the depths of Social Security and how some of these calculations are derived. And if you like what we are doing here, make sure you hit that like or subscribe button. We're about to roll out a whole series of new videos where we're going to take a deeper dive into Social Security, how to coordinate spousal benefits, when should you collect Social Security, working while collecting Social Security. That's been one of our most popular videos so far, and so I'm going to update that video here for 2019. And so with that, I will see you back in one of my next videos, and have a great day. Thanks.